So the EV multiple, the economic value added. So you want this to be positive because this shows the return that you're making on your investments. Obviously, Netflix here is negative, so that means they're not only not returning what they should be, but they're also incurring some losses. Facebook here, obviously, they're the greatest in the industry. They have an economic value added of 3,500. Yahoo, sitting there with a negative about 4,500. Twitter, about negative 1,200, 1,100. And there is Groupon with a negative 135. So obviously Facebook has owned the industry and economic value added. Here's your cash flows. We can see here they're all positive, which is a good thing. You want that to be positive. And in our conclusion for this industry, you can see Facebook owns ROE, ROA, economic value added, equity multiplier, and profit margin. They're obviously owning the industry. They do a great job. Very efficient with everything they do. Next, we'll move on to the soft drink and ice industry. We'll be discussing Pepsi, Coke, Dr. Pepper, who also owns Snapple, Monster, and Herbalife. Short-term solvency, current ratio, as discussed before, you want this to be greater than 1. Right here, you can see that Monster owns the industry right here with 3.04. The quick ratio, as discussed before, it's current assets, taking inventory out of your current liabilities. You also want this to be greater than 1. Coca-Cola is just underneath, which is okay, that's not bad, but you can see that Dr. Pepper and Monster are doing the best. Next, we have your cash ratio. This is obviously, like as discussed before, cash over all of your current liabilities. We'd like for this to be greater than 1 as well. You can see that Dr. Pepper, Monster, and Herbalife at the end of 2016 are all above 1, which is great. Notice going from 2015 to 2016, Monster made a huge dip from 7 to 1. We are assuming that is because they made a huge cash purchase for a long-term asset. We'll show that they use their cash pretty wisely by not taking on a lot of debt. We'll go to long-term solvency, equity multiplier. Once again, realize that this shows the amount of debt that they take on. This is also, as discussed before, 1 plus your debt to equity ratio. So if we subtract 1 from all of these, you can see that Monster is doing a great job. They have the minimal amount of debt in the entire industry. Times interest earned, you'll see here. This is obviously your earnings before interest and taxes divided by your interest. It shows how well that you can cover your debt. And we can see here that Monster, because they have so minimal amount of debts, that their operating income is obviously so large over the interest. That is why their ratio is so high. Go to asset management. So now we have total asset turnover. So you see here, that's once again sales over total assets. They're all relatively the same. Herbalife is above 1, which is pretty good, but you can see here from 2014 to 15 that Monster took a dip from 1.4 to 0.7, almost cut in half. We'll discuss that later on. Profitability, we have your profit margin, which is your net income divided by your sales. You want this to be as high as possible, maximize that. Once again, Monster owning the industry. Return on assets, this is your ROA. You want to maximize this as high as possible. Once again, you can see Monster is owning the industry and has been for the duration of our analysis. Return on equity, exact same thing. You want to maximize this as much as possible. Obviously, Coke and Dr. Pepper, they've been around for a pretty long time. Same with Pepsi. They're all relatively high. Monster had a 38.4 and then dropped to 17. Their Pepsi ROE is driven by an increase in their leverage. Coke ROE is driven by its EBIT margin, which is what you want it to be driven by. Monsters is driven by their profit and EBIT margin. Herbalife is driven by all leverage. They take on a lot of debt. And Monster went down because of that, we're assuming, of that cash investment in their long-term assets that we discussed earlier. Here's your DuPont analysis. You'll notice that, where is it? Monster here, you can see here they took on the least amount of debt. You know, Dr. Pepper is pretty good in this industry, although we don't like them as much just because we can see here that they took on a lot more debt than Monster. Monster was way more efficient. We'll talk about their market value. So your price to earnings ratio, Monster has the highest earnings potential than past returns, and you can see that they've consistently increased. They did take a dip in 2016, but we will discuss that later. And a lot of these other companies don't have much, not so much Herbalife, but Dr. Pepper, Coca-Cola, and Pepsi all kind of stay within the same range. They're all very mature companies in this industry, been around for a really long time. Now we have market to book ratio. So this is obviously, as discussed before, market value opposed to the book value. Greater than 1, a market to book ratio greater than 1 shows that they're creating value for their shareholders. So as you can see here, the whole industry is doing a great job. They're all creating shareholder wealth. So now we have the enterprise value multiple. So this is your enterprise value divided by your operating income plus depreciation and amortization. This is the enterprise value is the theoretical takeover price. We like Monsters because we know they don't have a lot of debt. So we know that theirs is high because of their operating income. So now we have the economic value added. As discussed before, we want to maximize this as much as possible. Pepsi, the whole industry does pretty well. Pepsi has a positive 3,200. Coke has a positive 2,000, 2,100. Dr. Pepper, positive 516. Monster, positive 450. And Herbalife has a positive 200. As you can see, the entire industry has done a great job with maximizing their returns. Now we have cash flows. As discussed before, you want this to be as positive as possible because that is showing the increase in your liquid assets. You can see here, Monster has steadily increased. They did have that one dip in 2015, but they've been able to increase steadily throughout the years. All of the other ones have stayed about the same. In conclusion, so we have Monster has the highest potential for growth because you can see Monster owns the industry in ROA, price to earnings, equity multiplier, and profit margin. We think that Monster has the highest PE ratio, not only because they're developing as a company, but Coke also bought 17% of their shares in 2013, and that's huge. That's a lot of a percentage of a company to buy, especially for an institutional investor. That means a lot. That means that, especially Coke, who's been around for a very, very long time. They will also, Monster has been really just local in the United States, and they're going to be able to use Coke's distribution channels internationally. So we believe that Monster is the best one in this industry because they have the highest potential for growth and earnings potential. Next is our last industry, sugar, grain, and oilseed. We'll be doing Archer, Daniel, and Midland, ADM for short, Bunge, Ingredient, Primo Water Corp, and Seaboard Corp. Short-term solvency, current ratio, once again, you want this to be greater than 1. They all do a very, very good job. Obviously, Ingredient and Seaboard Corp doing the best. Quick ratio, obviously this is where these two fall off. Inventory obviously is a big part of their current assets. So Seaboard and Ingredient both do a great job in this one. Cash ratio, it's just your cash or your liabilities. Seaboard Corp obviously has been able to develop it and bring it forward every year. Ingredient has somewhat gone down and gone back up. Long-term solvency, equity multiplier. Once again, this is showing how much debt that they've been taking on. They all stay about the same. We see Primo Water Corp takes on a lot more debt, and that's only good if you can actually maximize your returns and stuff like that. Seaboard Corp and Ingredient. Seaboard Corp is obviously the best one here that we think, just because it's 1.52 is the lowest one, and you want that to be as low as possible. Times interest earned. Seaboard Corp is decreasing because of a decrease in their operating income, which you will soon see in your total asset turnover because your times interest earned is, is your EBIT over interest. So this is your operating income over your interest, showing that how well you can cover your debts. And obviously you can see Ingredion here with times interest earned of 11, they can cover all of their debts 11 times over. So asset management. So this is your sales over your total assets. And you can see here, Ingredion 1.05 and Seaboard Corp here at 1.17. We know that the sales decreased based on the profit margin as well, which we will talk about next. So now we have profit margin. So your profit margin is net income divided by your sales. So obviously we can see Seaboard Corp has an increase in their profit margin because of a decrease in sales, because obviously as discussed, your profit margin is your net income divided by your sales. So you can see there, their Ingredion is able to maximize that as much as anybody in the industry. So your return on assets, you want to maximize this as much as possible. Ingredion, once again, is doing much better than everybody else in the industry. You have your ROE. Once again, Ingredion, maximizing it better than anyone in the industry, not just in 2016. They've been able to, even though they took a slight dip from 2012 to 2014, they were able to maximize it and bring it all the way back up to 20 in 2016. So here's your DuPont analysis. This is the ROE breakdown. You can see here, Ingredion has a little more debt, but they have a higher ROA, so they are managing their debt way more efficiently than anybody else in the industry, which is a very good thing to do. So we have your price earnings ratio. Seaboard Corp is a stock price of 4,000. So your price earnings ratio, as discussed, is your price per share divided by your earnings per share. So we can see, we went ahead and did some extensive research and just to see what is driving these ratios here. And we can see that Seaboard Corp, they have a stock price of $4,000. So it's a very, very mature company. It's been around for a while. They've been here in the industry for a pretty long time. You want your PE ratio to be pretty high. That gives you a basis for how much you will earn in the future. These are all pretty good. ADM, Bunge, Ingredion, and Seaboard Corp. I think Primo Water Corp is a little too high for my taste. That's just because it's a newer company. You know, they show extensive, potential for growth just because they are so new. That is not unlikely for new companies to have a very high PE ratio when entering into an industry. Market to book, obviously they're all positive, they're all creating shareholder wealth, they're all greater than 1, which is awesome. Obviously you can see here, Ingredion comes in second to Primo Water Corp. We're going to assume that Primo Water Corp obviously has probably the highest because they're such a new company in this industry. As you can see, they went from 2 to 4 to 7, and now they've dropped back down to 5.5. Whereas Ingredion has slowly been able to increase. Your enterprise value multiple, as discussed, this is the potential takeover price divided by, compared to your operating income in addition to depreciation and amortization. So here you can see that, Primo Water Corp, we're assuming that's because they've taken on a lot of debt, and that's probably what's driving that because it's such a new company. And you can see, maximizing here, Ingredion has a pretty solid one, Seaboard Corp is a pretty solid one. Next one, economic value added, okay? So as discussed, you want this to be positive instead of negative. ADM, negative 585. Bunge has a positive 81. Ingredion, positive 242. Primo Water Corp, negative 24. And Seaboard Corp has a negative 58. So up until this point, we really liked Seaboard Corp and Ingredion, but based on this, Seaboard Corp is incurring losses and not having the returns that it should be having. So based on that information, we kind of started to lean a little more towards Ingredion. So here's your cash flows. You want these to be positive, increase all your liquid assets. As you can see here, Primo Water Corp being the newer company that they were, increased by almost 400 from 2013 to 2014, and it's steadily dropped. You can see ADM, Ingredion, and Seaboard Corp, pretty high, pretty good ratios. So in conclusion, for this industry, we're going to say that we like Ingredion the most. They own the industry in ROE, ROA, EVA, and their profit margin. They are able to maximize as much for shareholders as possible. As we said earlier, Seaboard is a great company, but being such a mature company and having such a high stock price, it's not exactly ideal. Let's see. The next one. So here we have the top 3 companies that we liked, the top 1 from each industry: Facebook, Monster, and Ingredion. So as you can see here, Facebook owns all of these 3 in 4 of the different ratios. So you would think Facebook would be the automatic decision, right? No. Instead, I chose Monster. I think it's a great company. I think they have a lot of potential for growth. Ingredion, another great company. All of these are good companies to invest in. We put over here the price per share, just to kind of give you an idea in case you're price sensitive. For me, my best company to invest in as a shareholder would be Monster. They have the lowest price per share, but that's not the only reason. The other reasons are because, as I said earlier, Coke purchased 17% as an institutional investor, and it's going to allow them to use their international distribution channels and go international. So we think that they took a dip in their sales and those things earlier in their total assets and things like that when they made that huge cash investment. We're going to assume that's because they're adjusting to the international market. And we think the only competitor they have in the energy drink market is Red Bull. And all Red Bull sells is Red Bull. Monster has 3 other ones, I believe they're NOS, Full Throttle, and Monster. So those are 3 other energy drinks that they can sell on the international market. They should have a high potential for earnings, and that's why, as you can see here, they have the highest PE ratio, which shows us that they have the highest potential earnings. For that, Monster also has a great capital structure because they're a very liquid company and have a minimal amount of debt, and they're a very, very safe investment because, as I said, we think they're going to bring back a lot of returns. Monster also has a high EVA in their industry and has a high profit margin, demonstrating their higher returns that they'll be bringing in. As I said earlier, there will be the potential international markets. So our favorite industry that we went into, that we think investors should go into, would be the soft drinks and ice one. When we discussed earlier, we saw with the internet media ones, with Facebook and Netflix and them, and Ingredion, a lot of those companies had most of them had negative economic value added, which means they were not returning what they should be and even incurred some losses. Every company in the soft drinks and ice industry had a positive economic value added. They all were great companies to invest in. It's a mature industry. Coke's a great company, Pepsi, Dr. Pepper, they're all great. They're all going to show you returns on your investments, which is awesome. But, obviously there is that health craze going around and that could raise some concerns. But, soft drinks will be around forever. Everybody drinks soft drinks no matter how healthy or unhealthy they are. They will always be around. So they will all be giving you positive returns. They all look great. The final company that we think is Monster, which is of course in our favorite industry, which is the soft drinks and ice industry. Thanks.